Ladies and gentlemen, Bill Howald, President, CEO, and founder, of course, of from Right Patch Gold. The floor is yours.
Okay, great. Thank you so much. Thanks for spending part of your evening with us tonight. What I hope you're going to take out of my presentation are four things. One is where gold comes from. Two is some analysis that you might be able to use for some other gold companies, and you can see how that'll work, and I'll apply it to Right Patch. And four, what a great place that Nevada is to work, and one of the most important things is about jurisdiction. Okay, so one of the things I'll say just about the last speaker is one of the things you should look into with respect to the gold prices. I don't know if you know this, but there was a major policy shift in the FMOC when Ben Bernanke became not only a governor, but when he became Fed chairman. And I think if you look, they switched from trying to work with the Fed's funds rate, and they switched to targeting inflation. And when you see that, you'll see that's why gold is going up. Now that's why I believe that you're not going to see the Fed raise interest rates in December, because we're actually in a deflationary period. And so they can't raise rates because that's going to cut off the money supply, and we're going to have a big problem. So eventually it's going to catch up to them, but the answer is, or the question is actually when. Okay, so we're going to look at Right Patch Gold. It's a real simple story. There's three things that we're working on. First is we're driving our project, Lincoln Hill, towards production. That project has shown us a very robust economic, and we're actually looking at economics around $775 gold. We've got another area called Cortez. There, we're in the early stage projects. There's no resources, but they're in a very good location and next to some of the major discoveries that are happening in Nevada. And thirdly, and most importantly for you folks, is the fact that we're a fully funded company. We have cash in the bank and we have revenue. And we use that revenue to drive our exploration program, and we're going to use that revenue to build our next mine. So let's talk a little bit about Nevada. We really like Nevada, as I think you'll see it's a very good jurisdiction. If Nevada were a country on its own, it would be about the fourth largest gold producer in the world. It produces about 10% of the world's gold, a little over 200 tons of gold annually. And because of that, you have every major mining company operating in the state of Nevada. And you'll see what we've done with Right Patch is we've positioned the company in and amongst those operating entities. So we're in two areas, in west central Nevada along the Oriana Trend, and in east central Nevada along the Cortez Trend. So first let's talk about the Oriana Trend. I just give you a little bit of an overview of the neighborhood. So here's our Lincoln Hill project here in the blue area. Over here in orange, this is the Rochester silver mine. It's a heap leach only silver mine. So they produce about 5 million ounces of silver annually from heap leach. Up here is Barrick Gold's Spring Valley discovery. That's an advanced project that's heading into feasibility. So you can see we're sandwiched in between Barrick, Rochester, and here is our asset here, Lincoln Hill. Lincoln Hill, as it stands right now in the PDA that we completed last summer, is 600,000 ounces of M&I, or measured and indicated, and 400,000 ounces of inferred. And what we've done is we wanted to see if this deposit could be stress tested. We didn't want to go through all the pain and suffering of trying to put something into production that wasn't even going to be profitable at lower gold prices. And what our vision is right now is we want to have a series of deposits that are economic at sub $1,000 gold. Who knows where the gold price is going to go? But if it goes down below $1,000, we want to be able to make money, because that's what mining is all about. Mining's not about moving dirt around. Mining's about making gold, and gold is money. So what we've done is our pit shells here at $775 gold and $13.50 silver. It's a very robust little project. It's basically a small capex. It's got about $30 million to build the mine. And what we saw is in doing that, we have these really nice internal rates of return. So as I like to tell people, we don't mine just to mine. We mine to make money. That's what mining companies do. And so we want to go back to the old style where, we have a starter pit. And if gold price goes to 1,500, 2,000, or wherever it's going to go, we're even going to be better off. But we want to make sure that we can still make money if gold price goes lower. And so that's why we've done these lower gold and silver prices. This thing is cash flow positive, above $760 gold equivalent. And as I said, it's a really simple little mine. It's a typical Nevada mine. It's called run-of-mine, which is drill, blast, haul. If the material in that truck is above the cutoff grade, it goes to a leach pad. If it's below the cutoff grade, it goes to a waste dump. Real simple. Pour some cyanide on it, collect the fluid, and you make doré bars. So if we were to use today's gold price of about $1,100, this IRR would be about 50%. So that means for every dollar you invest, you get $1.50 back. And that's one of the reasons why the deposit pays back within a year. So we'll get our capital back within 1 year. Okay, now here's some ideas and some things that you should think about when you're looking at other companies, because one of the major aspects of something that's going to be profitable or that's going to become a mine is really the fact, what's its geometry? Do I have to move a big hill to get a little tiny deposit? And that's best expressed as what's called strip ratio. So you see that all the time in some of these PEAs and the feasibility studies, strip ratio. So in the case of Lincoln Hill, it has a very low strip ratio. So here the overall strip is 0.5 tons of waste for every 1 ton of ore. Okay, that's generally how it's expressed. The other nice thing about Lincoln Hill is the highest grades are at the top of the deposit. We don't have to mine a bunch of dirt to get to the higher grades. The higher grades come out first. And in fact, we're placing 40 gram gold equivalent blocks on the leach pad. Those are the first ore blocks to the pad. So that's one of the reasons why you get this really nice internal rate of return. It's got a favorable geometry and a good grade profile. The other thing we know is metallurgy. As I mentioned earlier, the Rochester silver mine is a heap leach silver mine. It produces 5 million ounces of silver from a heap leach. So silver recovers very good in this area, in a heap leach environment. And that's one of the reasons we went there. This has really been an area in Nevada that's been overlooked in the past. And so you've got a number of areas with historic mines, and we were able to discover Lincoln Hill.
What is a heap leach? Sorry.
So heap leach is a very low-tech kind of mining operation, right? Basically, you're going to drill, you're going to blast, you're going to collect that rock, you're going to put it in the truck, you're going to truck it down to a pad that's lined with plastic, you're going to dump it on that pad, and then you're going to spray it with cyanide. You're going to collect that solution, it's called pregnant solution, and then you're going to run it through a bunch of steel wool like you scrub your sink with, and then you're going to throw that steel wool into a real hot pot. You're going to melt it, and you're going to collect the gold out of it. That's basically heap leach. That's the mining process. We'll look at a schematic of what it's going to look like, and maybe that'll help answer any of your questions.
What about the environmental impact on this cyanide feeding? Is there any restrictions?
Well, I mean, you can't just throw cyanide on the ground. But one of the things that destroys cyanide quite readily is sunlight. So one of the things you have to do is you have to keep it at a certain pH, and you have to make sure that it's not sitting on the ground because it'll just dissipate into the atmosphere, right? And it'll be gone. So as far as Nevada produces 200 tons of gold from heap leaching every year. So cyanide is a big component of how the mining is done. Okay, so infrastructure is a big issue. I used to be on a couple of joint venture committees. One was a big project up in Alaska. And one of the problems that project had was there was no infrastructure. So no matter how big the deposit was, there's no way it's ever going to be a mine until they get infrastructure there. You had to go 500 kilometers to get power to that place. And so it has a real issue. And those are some of the things that you guys should look at when you're looking at projects. In addition, you should also be looking at what the jurisdiction is, right? So Nevada is got a mining history. There's people, power, water, mines, all that stuff is there. So if you don't have those kinds of things, say we wanted to build a big open pit mine in Switzerland up in the Alps, it's probably not going to happen, right? Because there's just not a mining history there. Okay, so let's look at the PDA. As I said, we did our PDA at $775 gold. That's this red pit here. If you use 1350, that's this black one. Okay, so instantaneously this thing can get bigger, and we hope gold doesn't go below 775. Okay, to start off our PDA, we did a number of metallurgical tests, 12 composites, 9 were oxide, 3 were sulfide. You can see that really nice recovery for both gold and silver. Even in the sulfide, you get good recoveries for gold and good recoveries for silver overall. And then, as I said, you know, here's our blocks. You get the highest grade blocks at the top. We'll take a look at that in these graphs. So, as I mentioned again, I'll go back to geometry. Geometry really is that strip ratio. It's waste to ore. This is a pretty low strip ratio. And that's what it looks like year over year. So, you know, the first year you got about 0.8 to 1. Here you got about 0.2 to 1. And the overall average is about 0.5 to 1. Grades, here we're starting with the highest grades first. So you've got about 1.3 grams and 20 grams silver. Just as an example, the Rochester Silver Mine, again, I'm going to come up and bring that up again, because they mine 0.2 gram gold and 20 grams silver. So we have 10 times the gold value and about the same silver value as the Rochester mine. Okay, so as I mentioned in the video, we were just launching into our phase 2 metallurgical program. And the reason that this is important is the fact that we're going to look at what, again, the Rochester mine does. And they actually crush material. So we have the same geologic environment as the Rochester mine, and basically the same style of mineralization. So what we wanted to do is, I told you we were using run-of-mine. Run-of-mine is just, you know, you're going to drill blast, you're going to haul chunks, and they're going to go however big the chunks are that blast out of the ground. You know, if you had a crushing circuit, then you're going to crush to a certain size. So what we're doing now is a series of bottle rolls and column tests. We've got our different rock types that we're testing in columns. We're looking at these various crush sizes, and we're going to build that curve, which is crush size versus gold liberation. And what we're looking for is that optimal size. And the reason that's important to us, because in our PEA, we use 64% recovery for gold. The Rochester Silver Mine has 92% recovery, and they crush. So if we can do crushing and we can approach that 90% plus recoveries, then that means we can mine the same number of tons, but get 40% more metal out. And what that equates to is better economics. That means we'll get our money back even faster and we'll make more money. Which in mining is important because you want to make money. Okay, so here's that little schematic that we talked about. So here you're going to have your pit is over here. You're going to take material. You're going to put it on a leach pad. You're going to put cyanide on it. You're going to collect the cyanide. You're going to run it through some carbon columns. You're going to collect it on steel wool. And then you're going to make doré bars. That's how mine works. Okay? So here is our PEA. In that scenario, we're getting 64% for gold and 59% for silver. This is the Rochester scenario. They do the same thing, only they have a crushing circuit in between the mine and the leach pad. They get 92% recovery for gold and 61% recovery for silver. So that's why it's important to us, because it'll have a huge impact on the NPV. Okay, somebody mentioned permitting, and we're in the process of permitting. So one of the things we want to do, we see the internal rate of return of the project is very high. And so normally what you would do is a feasibility study, get a positive feasibility, and then you would start your permitting. But we're pretty confident in what we see so far that we're doing the permitting in concert with the feasibility study. So we've got this big permit going, and this thing will allow us to do a big infill drilling program, about 15 to 18,000 meters. It'll be a phase 3 bulk sample where we'll actually blast material off the hill and do some sample or testing on that. And then it gives us all the surveys that we need that underpin a mine plan and the mine permit. So as we work our way through, this will be the foundation permit for the mine. Okay, so let's just look at a timeline then. This is why we're doing all this stuff. So we talked a bit about the metallurgical program. That's the phase 2 program. We should have results for that in the first quarter of 2016. We've got an infill drilling program that'll work through the first half of 2016. Then we have some design work, both process design and mine design. And the goal is to have a new PEA with these updated costs and metallurgical results by the end of 2016. This is our permitting. This is kind of a bottleneck for us. That's why we're doing it in concert with our feasibility. The idea is to have feasibility here at the end of 2017 and then have our mine in production here by the start of 2019. So it's a pretty aggressive program. And what we're doing is we're using our cash flow from our royalty revenue to fund all of this work. And so basically, if you want to look at it from a financial point of view, we're leveraging the low-risk dollars of our royalty into more or less low-risk dollars of production. Okay, now let's just look at some upside here. So again, here's our Lincoln Hill deposit here. We've got areas 2 and 3. Those are 2 exploration targets that are within a couple of kilometers of Lincoln Hill. In fact, Independence Hill, this number 2 area, is right adjacent to Lincoln Hill. So what we hope to do is, we have 1 million ounces sitting here at Lincoln Hill. If we can find another 500,000 ounces here and maybe another 500,000 ounces in that area 3, now we've got 2 million ounces within 2 kilometers of Lincoln Hill. And that could all go to a central leach pad. So it's not a very big business. Again, just for reference, this is the Rochester Silver Mine. And this square that you see going around the mine, that's where our royalty comes from. Okay, so our royalty is right here. That's why we talk about it so much. It's right next door. Okay.
What you get royalties for?
Because we had a bunch of ground that the mine wanted so that they could go into production. And so we sold that land and kept the royalty on it. Okay?
Those are separate biographies.
Yeah. Okay, so let's just look at the some events here. So as we talked about, if we use a higher gold price, that'll have an impact on the economics and the resource. If we, we're really excited by this crush size versus recovery because that could have a huge impact on the NPV that we talked about. Infill drilling, pretty boring. It's just going to be putting all the drilling to a 30 by 30 meter grid. We'll probably add a few more ounces, but it's a pretty boring process, right? We're just going to drill over and over and over again. Okay, and then this will be exciting though, the Lincoln Hill, or the Independence Hill and Gold Ridge exploration. So that could give us that extra 1 million ounces plus that can be part of the mine and go into the mine plan. Okay, now just going to briefly touch on our exploration projects. So we have in east central Nevada along what's called the Cortez Trend, we have 2 projects called Garden Gate Pass and Patty. And the reason we like these projects is this is Barrick here, Barrick Gold, and this brown area here is McEwen Mining. So we're sandwiched right in between those 2 areas. And what we like about this trend is in the last, say, 5 to 7 years, there's been a real epiphany in the geologic understanding of the district. So what's come to light is that you've got the similar rocks to what you see on the Carlin Trend. And now that you're able to put that together, you're able to understand the structural controls on gold. And what's really happened is if you look here, you get these increasing or decreasing amounts of time between new discoveries. And the other thing I really like about this area is you've got over 50 million ounces of gold discovered, mined, and processed in this area since 1991. That's a fairly short period of time. So our projects, are all along the trend. In this case, the trend is your friend. And very early stage, no resources. It's a very technically driven program. And just to give you an example, we're looking for a big Carlin deposit. But the drill holes are deep and they're very expensive. 5 drill holes cost about $1 million. So we don't do 20 holes here. We generally do between 3 and 5 holes a year. And it's a small component of our overall exploration budget in Nevada. Okay, just to give you some idea of where we're headed. So in Q1, we've got our MET program, the results of that, the infill drilling program the first half, our new resource and updated PDAC in Q3, our exploration drilling around Lincoln Hill in Q2 and Q3, and then we'll do some work at Patty, kind of scattered through, the Cortez area, scattered through the year. So, when we come through, we generally come through Europe twice a year. We come through in April to show people what our plans are. We come through this time to show you how we've done and then to show you what the next plans are. Okay, so this is a little more about how we fund everything. So as I mentioned, we have a 3.4% net smelter return on the Rochester mine. What it does at these gold and silver prices is it pays roughly $1 million US per quarter. So every quarter we get a check goes in the bank, and then we plan our exploration programs accordingly. Just like you would in your household, we try not to spend more than we make so that we can keep a cash balance in the bank. So we have a cash balance of about $5 million. The royalty, as I said, is $1 million per quarter at current prices. If silver were to go to $25 an ounce, it's $2 million a quarter. So the value of this is somewhere between $15 and $30 million. So that's how we're going to drive Lincoln Hill forward into production. Is we have all the money we need to get through feasibility, and we'll have a portion of the capex required to build the mine. Where we'll go back to the market is to go to a bank and see if we can get a loan to fund the rest of the capex. So again, that's really progress without dilution to shareholders. Okay, I'll just tell you a little bit about myself and my team. I came out of a company called Placer Dome. Placer Dome at one time was the second, third largest gold producer in the world. It got taken out by Barrick Gold at the end of 2005. I ran the U.S. and Latin American exploration programs for Placer, so I know intimately a lot of the assets that we looked at. I just showed you in Nevada because I actually worked on them for Placer Dome. I work with a team that I've been with for 15 to 20 years, depending on which person it is. But that group has been associated with teams and have led teams that have delivered over 100 million ounces of gold to the portfolios of Placer, Barrick, Santa Fe Pacific, and Agnico Eagle. And I'm proud to really say is that all of those 100 million ounces that they delivered are still in production today. So these guys know what they're looking for and how to find mines and what to do. So they're a pretty knowledgeable group of people. I bring up the CFO all the time because we're different than a lot of other junior mining companies in that we're a profit center. Most junior mining companies are a cost center. So because we have income and we have to think about taxes and capital deployment, we've hired our own CFO. We used to have a CFO for rent. Now we have our own internal CFO, just for those reasons. Our board of directors is very mining savvy. Jonathan Chalice is our chairman. Been around the mining industry for quite a while, and he used to work with CM Oliver and has done a lot of junior work both in equity and debt financing. Charles Russell is on the board of Ivanhoe Capital. He's also a mining engineer, and he's got over 40 years worth of experience, so he keeps us on the straight and narrow. He doesn't take much guff, if you know what I mean. And then Randy Buffington, he's also a mining engineer, very well versed in Nevada and heap leaching in Nevada. So all these guys are a very good source of information on how to do things. Okay, my final slide, I'll just show you our share price. Our market cap's around $20 million. Our main shareholders are Sun Valley and Kinross Gold. They own about 25%. US Global and Europac hold about 10% combined. So overall, institutional investors hold about 35%. Insiders have 5%. One of the things I'll just tell you that we're doing with our shares is we're taking a small component of our royalty income. And in May of this year, we announced a share buyback, which has happened right there. So we're using 10% of our royalty income to buy back shares. And we've got approval to buy back 7 million shares from the exchange. So we buy them back and then we cancel them out. So our overall total share count is getting smaller. So next time you see me, that number will be smaller. And anyway, that's my story. I thank you for your time, and I'd be happy to answer any questions.